All right. Today is Wednesday, July 6th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. It's going to be a heavy one. So let's not waste any more time. And here it is in focus tonight. One of the worst economic downturns in history. A dire warning from Mark Zuckerberg. You know, for over a decade or so, this economy has been under a drug, a stimulant, and that stimulant is called quantitative easing, in which the Federal Reserve keeps interest rates as low as possible, closer to zero, if not negative, and they stimulate the economy by printing more and more and more money. That makes the cost of borrowing a lot easier, a lot cheaper for corporations specifically. And the money printing, where does that money go? It goes into buying bonds, it goes into buying mortgage-backed securities. It goes into buying corporate bonds. But a lot of that money that floats in the economy after being printed by the Fed lands on the laps of hedge funds, retirement funds, pension funds, and they have to invest that money. What is the best way to invest money? The answer is the stock market. And under quantitative easing, when interest rates are too low, that makes companies with high growth more attractive to invest in, regardless whether they're profitable or not. Now, there are a lot of reasons behind that, mathematical reasons such as discounted cash flow, but all what you need to know for now is, under quantitative easing, investors favor high-growth companies regardless of profits. Under quantitative tightening, as we're seeing right now, investors appreciate companies with present cash flow, old-school companies producing lots of cash right now, regardless of growth. So now that we have been under quantitative easing for over a decade, a lot of these companies, high-growth companies, took the advantage of lower interest rates, which means lower borrowing costs, in addition to the billions and billions of dollars of inflows from pension funds, hedge funds, etc., that made their equity values surge significantly higher. In other words, these companies in the past decade or so have been growing tremendously, and that growth comes with expansion, which means hiring more and more and more workers. But now that we have inflation and we are shifting from quantitative easing to quantitative tightening, the opposite is happening. Companies, high growth companies, with no profits, with no cash flow, with bad balance sheets, are now suffering from increasing cost of borrowing and increasing cost of expansion. And therefore, they have to cut down their expenses as interest rates continue to rise higher. All of that money that they borrowed in the last 10 years or so, servicing that debt will cost a lot more. And for sure, inflows are now favoring defensive stocks, not these high-growth stocks. Well, in the last 10 years or so, the economy has been expanding because of high-growth companies. But now these high-growth companies have to cut down expenses, and the easiest way to do that is to get rid of employees, layoffs. And as the Fed continues to tighten the monetary policy by increasing interest rates, the more unemployment we will see in the economy. And that leads us to the dire warning from Mark Zuckerberg to his employees. Mark Zuckerberg, CEO of Meta, now seems to share this pessimistic view during the traditional weekly Q&A session with the company's employees on June 30. He said he expected one of the worst downturns that we have seen in recent history, according to an audio recording obtained by Reuters. Consequently, Meta will accentuate its cost reduction policy. Are you paying attention or not? The firm only plans to hire between 6,000 and 7,000 new engineers in 2022, against an initial project of 10,000 new recruits, indicates Reuters. It is therefore a revision of 30 to 40%. So they're going to slow down hiring dramatically. Now you have the lunacy of Mark Zuckerberg, his obsession with the metaverse, which is a mere glorified video game. It's not a real business, but he's willing to spend billions of dollars to fulfill this fantasy he calls vision. And of course, Facebook/Meta investors are not happy with the insane pace of spending and no guarantees at all whether the metaverse is going to work or not. On top of that, of course, Meta/Facebook is in the business of censorship, so they have an army of so-called content moderators and algos and engineers who design these algos to censor speech on Facebook, and that takes a lot of money to hire all of these folks. Again, it is no wonder why we're seeing the stock of Meta in the trash, but it's about to get a lot worse. Continuing, in May, a source told The Street the social media giant was planning to halt, or in some cases slow hiring, for most mid to senior level positions. The goal was to revise priorities and align hiring targets with current market estimates and pacing, the source said. To add to the miseries of Facebook/Meta, they have a problem with Russia. Now, Russians happen to be one of the most avid users of social media and streaming. So when Netflix and Meta decided to cut Russia from their operations, there is a cost to endure. And that cost is heavy. The company posted first quarter revenues of $27.9 billion, up 6.6 year over year. 6.6%, I should say. Nearly all of it coming from the new family of apps division the company created last year, missing analysts' estimates of $28.2 billion tally. Ad revenues were up 6.1% to $27 billion. But after suffering its first ever decline in daily active users last quarter, Meta said figures rose 4% from last year at 1.96 billion, just ahead of the street's consensus of 1.95 million. I believe it was a mistake when they said billion. It should have said million the first time around. But here it is, suggesting that the social media group has been able to offset the market share gains of China-based TikTok with both its Facebook and Instagram apps. So far, so good. But the company had, however, warned that the Russian war in Ukraine would weigh on its sales. Facebook was banned in Russia after the firm publicly voiced its opposition to Russian intervention by taking strong action to limit Kremlin propaganda on its platforms. Not the CIA propaganda, though. That's allowed. That's actually what rules Facebook and Meta. But anyhow, here's the problem. The company is projected to lose billions of dollars. Meta could be bracing for a tornado-like quarter. We're about to head into earnings season. Watch out here. And this is coming from Wedbush Dan Ivis. You know, Thupathakal Dan Ivis, who's a perma-pumper. Even he's saying that Meta could be bracing for a tornado-like quarter. And we are all on pins and needles waiting for the announcements this earnings season. No, not the earnings announcements, but actually the layoffs announcements. You're going to hear a lot of those because we're hearing these oligarchs, these big tech oligarchs, the likes of Zuckerberg, for example, threatening employees, cracking the whip against employees. Why? Because they have to reduce cost as the Fed continues with its quantitative tightening mission. What does that mean? It means if you work for Facebook or any other company, you must ask yourself a simple question. Am I really valuable to this company? Can the company do without me? And if the answer is yes, then watch out here. You could be losing your job. Next year, no more job. You're fired, baby. You're gone. And the question now becomes, can you still pay your mortgage? Can you still pay your credit card bills? Can you still pay your rent? Can you still pay your utility bills? Can you still pay the bill at the grocery store? And if the answer to all of that is no, I depend on my job 100%, then you better start planning and preparing now. Because Mark Zuckerberg is warning staff, this is at Facebook of course, that he will be turning up the heat to weed out underperformers. He added, you might decide this place is not for you, and that's okay with me. That should make Facebook employees extremely nervous. Who's going to be next? This is all of a sudden the Hunger Games. I mean, who's surprised here when you have the CEO, Mark Zuckerberg, showing up to his employees waving a katana sword? I mean, that's terrifying when you see a lizard waving a katana sword. Run for the hills right away. But it's not just Mark Zuckerberg. It's all over the place. It's all of these oligarchs all of a sudden cracking the whip against their employees because they have to reduce costs. You have Reverend Elon Musk, for example, who's now tracking office attendance and sending emails to employees who have not badged in often enough. In other words, if you're not going to work physically, watch out. The next sound you're going to hear is you're fired. And we are already seeing the layoffs in Tesla, which, by the way, is planning to lay off thousands of employees, over 3.5% of its entire workforce. He was a guy who said, I just got laid off from my dream job at Tesla without warning. I feel like my life got uprooted. So a billionaire could save some money. Surprise, surprise. This story is going to happen over and over and over again. Now, these oligarchs, Zuckerberg, Reverend Elon, and the rest, Jeff Bezos, all benefited from the quantitative easing mania and the stock market bubble mania. They all sold their stock at the top, be it Zuckerberg, be it Elon, be it Bezos, be it all of them. And they cashed in billions of dollars. Now, are they going to cut costs by maybe pumping more of that cash into buying their stocks or investing in the company? Of course not. They're not going to do any of that. They're going to reduce costs by firing your ass. That's what's going to happen. This is the beauty of capitalism, isn't it? Which is not capitalism, by the way. It ceased to be capitalism long time ago. This system that we're in right now is an oligarchy. It's gangsterism. It's not capitalism. And here comes the tsunami of layoffs. The headline reads, this time is ripe for Wall Street layoffs as recession looms and deals boom turns to bust. Here it is. Release the Kraken. JP Morgan is laying off or reassigning more than 1,000 employees in its mortgage division as the housing market cools off. And it's not just going to be the housing market. It's going to be all over the place. It's inevitable that the recession will happen. For now, everybody says, oh, commodities are down. The unemployment rate is way down. So maybe inflation is peaking and moving down, and the economy is going to survive. And there we go, the soft landing. This is a fantasy. Inflation might cool down, but it's not going away. And as it continues to linger, it will create more and more damage in the economy by slowing down the pace of economic activity and causing unemployment anyways. And then the Fed, if they decide to wait, at some point they're going to realize that they're too late to the game. Inflation is not going away. There's a lot of damage in the economy, but they have to induce even more damage by slamming their foot in the brakes and increasing interest rates dramatically in a short amount of time, which will cause an economic slowdown to morph into a massive recession. And hence, the Fed has no other choice but to continue to tighten the monetary policy right now. We'll talk about the Fed in a minute. But again, we're seeing the beginning signs of the upcoming tsunami of layoffs. Companies like Netflix, JP Morgan, Century Aluminum, Tesla, Compass Realty, Redfin, Coinbase, all laying off employees. And this is not the only list, by the way. Many other companies laying off hundreds, if not thousands of employees as we speak right now. And to tame down this inflation, it doesn't take a genius to figure out that the level of demand in this economy is unsustainable, given the supply chain problems, and therefore the demand in the economy must be reduced. Now, how would the demand in the economy be reduced? The answer is layoffs, higher unemployment rate. This is not just me saying that, it's Larry Summers, who've been right about this inflation from the get-go. Matter of fact, Larry Summers says the U.S. needs 5% jobless rate for 5 years to ease this inflation. Now, when he says 5% for 5 years, it's either going to be that, although I would say 5% is a mild projection, it should be 6% or so, or we're going to have to increase the unemployment rate dramatically in a short amount of time, let's say to 8, 9, 10%, and then we get that unemployment rate in a recovery down below 5% in, let's say, 3 years or so. In either case, it is a dire outlook. No doubt about it. And of course, the amateurs at your beloved media, who only care about their political bias, by the way, no regard whatsoever to the facts. And here's an example. The headline reads, here's why Larry Summers wants 10 million people to lose their job. He doesn't want 10 million people to lose their job. He is saying that that's inevitable. To reduce the demand in the economy, we need to have unemployment. Period. Full stop. All of this could have been avoided if the Fed acted early on. But the Fed kept saying inflation is transitory. We're not thinking about raising interest rates. And now they're playing catch up. And there is going to be a lot of damage to this economy. The longer they wait, the higher the severity of the damage. Even Powell, it's not just Larry Summers. Jay Powell himself, the chairman of the Fed, says no guarantee the Fed will tame inflation while sparing jobs. In other words, you're gonna lose your job. There's a high possibility, if you're working remotely right now, that you're gonna lose your job. This is the same guy who said a few months ago that there is a possibility the economy will have a soft landing, a happy ending. Everybody lives happily ever after. Inflation goes away, nobody loses their job, and there you go, the soft landing. Now he's saying there is no soft landing. It's going to be rough. Buckle up your seatbelts, because we have a lot of indicators that are telling us right now that the tsunami of layoffs is around the corner. Among them, the correlation between the University of Michigan Consumer Sentiment Index and the U.S. unemployment rate. Well, the Consumer Sentiment Index is reading the worst reading in history. And every time we've seen such pessimism in the U.S. Consumer Sentiment Index, the unemployment rate have risen higher. For now, the unemployment rate remains low, but if this correlation holds, soon enough we will see unemployment shooting up higher, perhaps even higher than the height of the pandemic crash, in which the unemployment rate shot up to more than double digits. Now, why would the Consumer Sentiment Index read such a pessimistic reading, the worst in history? Well, that leads us to inflation. And again, a reminder, inflation was never caused by supply chain issues, a virus, or the misalignment between Jupiter and Neptune or Uranus. None of that caused inflation. What caused inflation is the reckless policy by the Federal Reserve, because inflation has always always been a monetary phenomenon. The Fed, in response to the Great Panic in 2020, decided to unleash the tsunami of liquidity, the likes that we've never seen in human history, printing trillions and trillions of dollars, where the balance sheet shot up higher from about $4 trillion to over $9 trillion in a short amount of time, and therefore we have inflation. Likewise, the Fed's fund rate remains extremely low, closer to zero, even after the last rounds of tightening. In other words, this is the reason behind inflation. And to tame down inflation, all of this has to be corrected, quote unquote. What does that mean? The balance sheet has to be reduced back to average levels, back to normal levels. That means dumping trillions and trillions of dollars off the balance sheet at a loss, and that requires the Fed funds rate to be normalized. That means matching this level of inflation. Well, for now, we're seeing the PCE inflation, the Fed's favorite measure of inflation, because it is cooked, of course. It tends to underestimate the true nature of inflation. No wonder why it is the Fed's favorite measure of inflation. But even that reads 6.3% increase in inflation year over year, although we're seeing signs that this inflation is cooling down, perhaps peaking. The problem is, it's not whether it's peaking or not. The problem is whether it's going to stay or just disappear magically. And the answer is, it's going to stay here and stick for a long time. It might go to 6.5%, 5.5%, but that's too much. That's way above the Fed's target of 2.5%. And of course, we know that all of these inflation estimates by the Bureau of Labor Statistics, they're all cooked. The headline reads, inflation has been pummeling the middle class for decades, but the out-of-touch CPI masks this reality. A rare moment of honesty by your beloved media. This inflation is surging out of whack. It crushed the spending power, the living standards of families in this country. The average grocery spending between March 2022 and May 2022 has risen dramatically. We're talking in the span of a few months. So when we talk about the consumer sentiment dropping down in the toilet, this is the reason. Inflation is sky high. It is costing families an enormous amount, an enormous cost. U.S. adults are now paying 11% more in the grocery store between March of this year to May of this year. That's insane. And no, the spending is not increasing because they're buying more items or they're eating more. They're spending more because prices went higher. They're actually eating less. They're actually cutting down on their consumption, but still spending more because prices are out of whack. Americans are buying cheaper cuts of meat, slashing subscriptions, and using vacation days to save on gas amid soaring prices, according to a new report. 44% of Americans work a side hustle to make ends meet. Why would they do that? Once again, inflation is out of control. For example, in the city of San Francisco, which used to be a great city, now it's a city if you want to see not the Golden State Bridge, but instead if you want to see what human feces look like on the sidewalk, welcome to San Francisco. But even in that filth, affordability is nowhere to be found. Matter of fact, you need to be worth $1.7 million to be financially comfortable in the city of San Francisco at a minimum. Even folks who are earning $250,000, one of 3 Americans earning that amount are saying that they're living paycheck to paycheck. Rents are out of control. Mortgages out of control. Prices at the grocery store out of control. Utility bills out of control. The prices at the pump out of control. Everything is moving higher around us. Except our wages, of course. Our wages are lagging. Net, most Americans are actually down because inflation went higher by about 8.6%. And mind you, this is the cooked number. The real number is above 20%. Meanwhile, your wages went higher by a pathetic, a little over 5.5%. Net, you're down. You're losing money in this inflation and in this trash of an economy. And there is no stop in sight for this inflation, even with commodities down, because wage inflation continues to go on. And so long as we have all of these people having jobs and the spending power while the supply chain remains challenged, even if that spending power is being reduced from the demand side, that will still maintain inflation higher because you have shipping costs adding about 1.6% to this inflation. And that's not going down anytime soon. They cannot find sailors and ships and workers. They need to pay them more. When they pay them more, they have to pass that extra cost to the end consumer. The American people are suffering from this inflation, no doubt about it. The New York Times says, so stressed out. Gas prices force many to rethink driving and spending. People are getting killed at the pump. They're canceling birthdays. They're canceling vacation plans. They're accepting living at a lower standard to cope with this inflation. This is happening in the richest country in the world, by the way. I exhausted my savings. Inflation has Americans turning to loans, credit cards to cope. Does it pose big risks? Yeah. You know why? What happens when prices around you continue to move higher, but net, when you factor in your wages, you're actually down, you're losing money. Well, you have to make up for that difference. For a long time, we had savings rate. The savings rate was high, but all of that savings is now spent in the economy. The stimmies, all of that's gone. So you have to make up for that difference by swiping those credit cards up and down, up and down, up and down. And this is exactly what the consumer is doing right now, which is extremely dangerous. Why? Because as the Fed funds rate continues to move higher, when the Federal Reserve is tightening the monetary policy, interest rates on credit cards are also surging higher. The question becomes, what happens when you lose your job after maxing your credit card, and now you have the interest rate on that debt that you have on your credit card increasing higher and higher by the day? Average annual percentage rate, APR, for new credit cards have reached a record high. The average bank card borrowing rate in America in June rose to around 20%, revealing a steep increase of about 6% compared to the pre-pandemic average credit card rate of 14.87% in 2019. Credit card interest rates are basically the highest they've ever been. I've been watching credit cards rates on a monthly basis for more than a decade now, and it is the highest that they've been since I've been tracking them. This is according to Matt Schultz, who's from LendingTree. Schultz predicts that consumer borrowing costs could continue to rise significantly. And listen to this, the troubling truth is that we are nowhere near where the top is going to be, he said. That interest rate could reach 50% if inflation persists and the Fed continues to increase interest rates higher. Watch out here. You better have a plan. But rest assured, your beloved senile leaders, they're going to take care of your problems. They're working on it right now. For example, if you're pissed off about the insane prices at the pump that you paid during the holiday, well, rest assured, President Joey B says, if you're angry about that and you're wondering how long you have to pay, how long do you have to continue to pay higher prices? Joey B says, as long as it takes. Why? Because he wants to defeat Putin in Ukraine. Take a look.
The war has pushed prices up. They could go as high as $200 a barrel, some analysts think. How long is it fair to expect American drivers and drivers around the world to pay that premium for this war?
As long as it takes. So Russia cannot, in fact, defeat Ukraine and move beyond Ukraine.
Now, is he the president of Ukraine or the president of the European Union, or is he the president of the United States of America? Your number one job is the prosperity of the American people, not these adventures overseas that are bankrupting our country amidst an insane inflation and an upcoming recession. Is Ukraine part of the United States of America? Last time I checked, no. But here he is again. He explains more. Perhaps the answer of, you got to suffer for as long as it takes because we have to defeat Putin in Ukraine. Is that really the real reason? Well, Joey B is going to add more color to that. Take a look.
So for all those Republicans in Congress criticizing me today for high gas prices in America, are you now saying we were wrong to support Ukraine?
Yeah. Where is Ukraine, by the way? Is it within the borders of the United States? Why do we have to defend Ukraine? It's in Europe. How come the Europeans are not defending Ukraine? How come a country thousands of miles away has to endure pain on its own population to defend a country thousands of miles away? What's going on here?
Are you saying we were wrong to stand up to Putin?
Yeah. Did Putin invade the United States? Did he invade Miami or Los Angeles or New York? No. So again, why do we have to buck up and take more pain as long as it takes to defeat Putin in Ukraine, a foreign country? Why are we so invested in a foreign conflict?
Are you saying that we would rather have lower gas prices in America and Putin's iron fist in Europe?
Yeah, I don't care about Putin's iron fist or copper fist. What are you talking about? Your job is the American people, yes. Your job is to improve the economy and the livelihood of the American people, not to induce more pain on them for the sake of a foreign country and a foreign conflict. But again, all of that is not convincing. Really, we have to endure all of that pain at the pump to stick it to Putin in a foreign conflict? Really? Is that the real reason? Well, remember Brian Deese from the BlackRock administration? Well, he slipped and revealed the truth. Take a look.
They say that this could be a long war measured in years, and I think everybody understands why this is happening, but is it sustainable? What do you say to those families who say, listen, we can't afford to pay $4.85 a gallon for months, if not years. This is just not sustainable.
Well, what you heard from the president today was a clear articulation of the stakes. This is about the future of the liberal world order, and we have to stand firm.
Say what, senor?
Well, what you heard from the president today was a clear articulation of the stakes. This is about the future of the liberal world order, and we have to stand firm.
Oh, the liberal world order. Oh. Do we have an agreement or a constitutional amendment, or did we sign or anything? Any piece of paper that says, yes, we, the American people, volunteer to receive more pain and more economic hardship to preserve and protect the liberal world order? I didn't hear that. Nobody told me that. And of course, after such a slip, the deep state interfered and took Brian Deese's camera down.
We need to take very seriously that. Whoa, guys.
Our camera fell down.
No, I'm kidding. That was from a previous interview, but I'm surprised. I'm really surprised they let him go on. But rest assured, your boy Joey B., the President of the United States, has your back once again. He always got a plan. If the Putin price hikes did not work out, if, hey folks, let's buck up here to preserve the liberal world order, if that's not landing, there is another boogeyman that Joey B is taking on, and that is greedy gas stations. He went on barking against gasoline stations, saying that you have to lower your prices now. Come on, man. You know the thing. Meanwhile, gas stations, the majority of them are owned by small businesses. Mom and pops, who you destroyed by the draconian lockdowns during the thing, and they lost millions of dollars. Some of them went bankrupt, and now you're asking them, when finally business is turning around, to stop being greedy? Even Dr. Evil Jeff Bezos called him out on this. Jeff Bezos says Joe Biden's call to cut gas prices is either straight-ahead misdirection or deep misunderstanding of basic market dynamics. I mean, when you're so bad that I have to side with Dr. Evil, how low can it go? But again, like I said, Joey B has more plans. If blaming greedy gas stations not landing, how about finally bowing down to China and removing the tariffs? Yep. Why? Because lifting China tariffs could slash inflation by 1% over time and help Biden in the midterms. This is according to U.S. Ambassador. So there you go. That's all what they care about. Not your livelihood, but staying in power. But unfortunately to Joey B, this is not going to work out because the unions, the AFL-CIO, who he spoke to them, by the way, I believe a few weeks ago, they say we think it is the wrong time to relax tariffs on China because it's going to hurt American businesses. But rest assured, if the Putin price hikes not landing, if preserving the liberal world order is not landing, if blaming greedy gasoline station owners is not landing, if relaxing tariffs on China not landing, Joey B got an ally who's going to solve his inflation problem. And this ally is the recession. You see, for now, we have reliable indicators that inflation is indeed peaking and cooling down. For example, the costs for logistics, be it inventory, transport, warehousing, all cooling down, not as much as they need to, but they're going down, at least for now. We're seeing a crash in commodities, be it crude oil, be it softs, be it grains, be it metals. Metals are crashing so hard, we have not seen such a crash in metals since the Great Recession. So does that mean that inflation is going down and we're not going to lose any more jobs? The Fed doesn't need to tighten anymore. Everybody lives happily ever after. The stock market goes higher again. Well, no, and you better wake up. What does the headline say? Since the Great Recession, you're not in good company when you have copper prices crashing like we're seeing right now. That is an indicator for an upcoming recession. That is an indicator that inflation is cooling down for the bad reasons, among them a recession. It's not cooling down because supply is catching up with the demand, or the demand is organically cooling down. Inflation is moving down due to recession expectations. BlackRock Vice Chairman says inflation has likely peaked, but the Fed won't be able to get it back to 2% target without causing significant damage. What is that damage? What is he talking about? We go back to Mark Zuckerberg's warning, the tsunami of layoffs. Liz Young says, while the May PCE inflation went down, we talked about that, inflation is cooling down. The bad news is it is cooling down for the bad reasons. Consumer spending is moving down. This is what's causing inflation to move down. Consumer spending is slowing down because they have to spend more on inflation at the gas pump, at the grocery store, paying rents, utilities, not stimulating the economy by buying goods or services anymore. We have more indicators that the economy is falling apart and inflation is going down for the bad reasons. Look at all of these regional surveys from the Philly Fed, from the Kansas City Fed, the Dallas Fed, the Richmond Fed. All of these indicators for the economic outlook are moving down. Not only that, we have the Chicago PMI also moving down. It is still within expansion territory, but it is moving in the wrong direction. It is collapsing. And who's to say it's not going to move down to contraction territory soon enough? Look at U.S. business activities collapsing. This is the second lowest reading since 2020 and the weakest since July 2020. Again, inflation is moving down for the wrong reasons. not because demand is cooling down, but because it is collapsing in the economy. And no, it's not in your head. 2 new surveys show that the economy hit a wall in June as stagflation becomes reality. This is from Chris Williamson, the chief business economist at the S&P Global. He says, having enjoyed a mini boom from consumers returning after the relaxation pandemic restrictions, many services firms are now seeing households increasingly struggle with the rising cost of living. He also added that the pace of U.S. economic growth has slowed sharply in June, with deteriorating forward-looking indicators, setting the scene for an economic contraction in the third quarter. Business confidence is now at a level which would typically herald an economic downturn, adding to the risk of a recession, he said. And again, when inflation forces consumer spending to be reduced in certain corners of the economy which are deemed to be inessential, such as shopping at retail stores, buying goods, etc., that becomes unimportant when you're spending more at the pump, on rent, on utilities, at the grocery store, and therefore we're seeing factory activities in this economy slowing down to 2 years low. So we're seeing the pace of economic activity moving down, and hence moving that inflation down slightly, causing the stagflation phenomenon for now. But again, inflation is moving down for the bad reasons, and soon enough we'll find ourselves in a recession because the Fed must act. Another corner in the economy where we're seeing recessionary forces of the demand suddenly disappearing, leaving that corner of the economy oversupplied, is in the chips industry. Last week we got earnings from Micron, and it revealed an oversupply problem. All of these orders in 2020, 2021 to cope up with the insane level of demand fueled by easy money policy by the Fed and stimmies all over the place. All of a sudden, when the demand goes down because of inflation, because inflation is forcing that demand to move down in certain areas in the economy to compensate for others, these industries, these companies find themselves with their pants down, oversupplied. Well, now they have to eat a loss. They might need to sell that inventory at a loss. And if that happens, the company has to cut down expenses because their financial health is going down. How do you cut expenses? Cutting jobs. And once again, back to Mark Zuckerberg's warning. Because is the consumer going to spend more money buying electronics right now, which demand more chips, when we have the share of families with children reporting food insecurity in this country reaching over 10% of households? You combine that with the fact that they're spending more at the grocery store. That's due to inflation, and they're facing food insecurity. Of course, that's going to cause the demand on chips and soon enough on services, traveling, etc. to suddenly disappear. And the problem this time around, don't look for the Fed or the federal government for that matter for rescue. If the economy indeed goes into a recession and people lose their jobs, there is not going to be any stimmies or unemployment benefits. You're on your own right now. Interest rates are moving higher. The Fed cannot print more money. They actually need to reduce the amount of money floating in the economy, which means this could be one of the most painful recessions we've ever seen. And remember when I talked about demographics and the income brackets and how recession is moving higher from the poor to the lower middle class to the mid class to the high mid class? We saw Restoration Hardware reporting the same problem, oversupply, no demand, because even the higher middle class is getting hit. Now even the rich are getting hit, evident by the price of Rolex watches. When the rich are doing fine, stocks are moving higher, crypto is moving higher, real estate values moving higher, and they're cashing in, they're going to spend that money buying luxury watches. And that fuels prices to move higher on brands such as Rolex. But when they start to feel the pain and they spend less, the demand goes down on these kind of watches, prices also go down. So far, in this economic downturn, the rich have been spared from the recessionary fears and the downturn in the economy. Until now, we have the prices of Rolexes going down, and soon enough, even the fine wine index, an economic indicator for the health of the rich class in the economy. Well, so far, it has been beating the S&P 500. It gained about over 10% year to date, but soon enough, that's going to go down too. When it does, you know that even the rich are feeling the pain in this economy. Not necessarily fearing their jobs being lost or losing their homes or mortgages, but they have fears that they cannot continue to spend as they used to before. And historically speaking, how bad would this recession be? Well, we have inflation that is morphing into stagflation, which in reaction to the Fed's action of quantitative tightening will become a recession. The closest example that we have is 1981, when Paul Volcker started tightening aggressively. In that recession, the economy lost about 3% of GDP. The recession lasted for over 16 months. That was on top of another recession in 1980 that lasted almost 7 months and shaved about 2.5% of GDP. So if that is the case, it could be really painful. It could last for too long. And even the World Bank is now coming out saying that inflation might last for 2 years, and some countries will find it very hard to avoid a recession. The banks are preparing for it. Their CET1 ratio, in other words, known as the cushion that they have in backup in case the economy turns sour. Well, they're increasing that reserve, bracing for impact, building that cushion before the impact happens. But the question is the Fed using any cushion left in this economy to initiate quantitative tightening while the economy can absorb some of that hit? Is the Fed building some ammo by increasing interest rates for when they need it, when the economy turns sour and hits a recession? Let's talk about the final piece of the puzzle, the Fed. As inflation continues to cool down for the bad reasons, the economy loses the cushion that it has to absorb the shock from increasing interest rates by the Fed. And as that continues to go on, the Fed loses its chance to increase interest rates to fight inflation while inducing minimal damage to the economy. So the folks who say that inflation is peaking, that's good news, we're going to have the soft landing, you have absolutely no clue what you're talking about. Even Ray Dalio says it is naive to think that the Fed's rate hikes will make things good again. They're not. And for now, we have conflicting messages from the Fed. For example, the zombie from Cleveland, Loretta Mister, says that the Fed is just at the beginning of raising U.S. interest rates. But we have another creature from St. Louis, James Bullard, who likes to smoke certain substances and then issue blunt statements. Well, for now, Bullard agrees with me. He says rapid rise in interest rates now is the best way to avoid a recession later. But he also tries to put a lipstick on a pig and sell you a fantasy. At a UBS conference in Switzerland, James Bullard said an aggressive response is the best way to nip inflation in the bud before it gets entrenched in the economy. Mr. Bullard, just a little note for you. It is already entrenched in the economy. The quicker inflation starts to moderate, he said, the less the Fed will need to raise rates later on. If all goes well, inflation starts coming down to our 2% target. Good luck with that. You won't need the policy rate to be so high, Bullard said, but he needs to be so high. He pointed out to strong consumer spending in the U.S. labor market as evidence that there is no broad economic slowdown underway. Maybe somebody send this link to Mr. James Bullard so he can see all the evidence of the so-called strong consumer. While a recession is certainly possible, he said, I actually think we'll be fine. Okay, we'll take your word for it, Mr. Bullard. Other senior Fed officials have echoed that view, including Chairman Jerome Powell. But it is exceedingly rare for central bankers to predict a recession given the power they have over the economy. And here it is, the political sensitivity of such declarations. God forbid somebody loses the election, right? And here it is, Bullard completely losing his mind. He says that the U.S. economy should continue to grow in coming quarters. These quarters can be right now or it could be quarters in 2050. He didn't really specify. But this is what happens when you speak while you're on drugs. And this economy has been a drug addict for a long, long time. From who? From the biggest drug dealer in the universe, the Federal Reserve, with its cocaine operation of quantitative easing. Trillions of dollars all over the place. Even the Big Short is now comparing the Fed stimulus to drug addiction. Berry said in a now deleted tweet, drugs are hard to kick. Fed was supposed to sell $30 billion in treasuries and $17.5 billion in MBS per month starting June 1st. Quantitative tightening. During June, MBS holdings actually rose by almost $3 billion, and Treasury holdings fell by less than $10 billion. They were supposed to go down by $30 billion. What does that say? The Fed is way, way behind the curve, and they have to do a lot more tightening for this inflation to go away, and it's going to come with a lot of pain. On top of that, you think when they do all of that, getting rid of mortgage-backed securities at a loss and selling treasuries at a loss, losing hundreds of billions of dollars on all of their so-called investments, you think that's going to come with no consequences at all? Think again. Anyhow, we have to move on now because we spent a lot of time in this macro discussion, but I thought it was important. So I'm going to be more brief than usual in the stock market coverage because we don't have time. So let's start doing that by covering the performance of indices today. And here we go. The Dow Industrial Average closing in the green by 69.86 points, or a gain of 0.23%. The Nasdaq also in the green by 39.61 points, or a gain of 0.35%. The S&P 500 in the green by 13.69 points, or a gain of 0.36%. The sector's performances, look at this. Utilities back on top, capturing the gold medal at number 1, and at number 2 for the silver. Technology, number 3 for the bronze, healthcare. Meanwhile, the laggards of the day, once again, energy, followed by real estate and consumer cyclicals. What about the advance to decline ratios? NYSE 35% advancing versus 62% declining. The Nasdaq 44% advancing versus 50% declining. So despite the fact that the indices closed in the green, by looking under the hood, we can find out that the breadth was actually bad. Commodities, the decline in oil continues to go on, be it moderating. The WTI was down about 1%, while Brent was down a little over 2.25%. The gasoline RBOB is down again, losing about 3.75% today. Heating oil down once again, with big losses contracting by about 5.5% today alone, while natural gas rebounding slightly with gains of about half a percentage point. In softs, we see a rebound in lumber futures gaining about 5.25%. We also have gains for sugar and cocoa futures. On the other hand, more downside for cotton futures, losing over 5% yet again in a single day. We also have coffee futures and OJ also trading down. Metals, what's going on here? A massacre for gold continues to go on, yet silver and copper bouncing slightly, while we have modest losses for platinum and palladium futures. Meats, what's going on here? Gains for live and feeder cattle futures. Live cattle gained almost 1.25% today, but once again, the king of meats, the new big tech lean hogs futures, gaining over 3% today. Massive gains so far for lean hogs. On the other hand, grains, we have muted activities for rough rice, wheat, no major movement whatsoever. We have losses, but they're moderating for both soybean oil and oats. On the other hand, we have a rebound for corn. It's a modest rebound for now, along with a rebound in soybean meal and soybeans futures, while canola futures continue to move higher, gaining an impressive a little over 7.5% today. Moving on to options, the big casino, what's going on here? Coming up at number one, the hottest table in the casino for now is Apple, trading around 765,000 contracts today. About 53% of those were calls. At number two, Amazon, at around 650,000 contracts traded for the name today. About 57.5% of those were calls. Number three, Tesla, the souffle, at around 450,000 contracts traded for the name today. About 48% of those were calls. So again, they're buying more puts than calls. We're not seeing improvement in call options volume, and therefore the sustainability of this rebound remains under question. Here are the unusual activities that took place in the options market today. We start with the ticker GLD for the gold ETF. Lots of pain for gold so far, and somebody's betting for more pain to come. By buying the 150 puts for the expiration date, July 29th, with the expectations that the name could move down by more than 7.5% by then. They paid around 45 cents apiece to enter this trade, all in all spending around $2.6 million. Then we have the ticker MDT for Medtronic. They're buying calls this time around. It is a loser year to date, down about 15% or so, but somebody's betting for a rebound here, buying the 95 calls for the expiration date, August 19th, with the expectations that the name could move higher by more than 6% by then. They paid around $1.20 apiece to enter this trade, all in all spending around $1 million. What about AMD? For, you guessed it, AMD. Somebody's buying calls here, the 81 calls for the expiration date, July 15th, with expectations that AMD could bounce higher and gain more than 6.5% by then. They paid around 95 cents apiece to enter this trade, all in all spending around $750,000. I am in the same trade, by the way, but I have the 80 calls. Same expiration date, no guarantees here, but it appears that AMD might catch a relief rally. We'll cover the chart of AMD if we have time in the charts analysis. But for now, what about the Qs? We have a call spread. They bought the 315 calls and sold the 325 calls, all for the expiration date, August 1st. And the expectations here for the Qs to gain more than 8.5% by then, but not more than 12%. They paid around $1.25 apiece for buying the 315 calls, and they received in credit about 25 cents apiece from selling the 325 calls. All in all, the entry cost is down to $1 apiece, bringing the total to about $650,000. What about the put spread this time around for the ticker OIH? This is an ETF for oil and gas. They bought the 185 puts and they sold the 165 puts, all for the expiration date, August 19th. The expectations here are for OIH to go down by more than 12% by the expiration date, but not more than 22%. They paid around $7.40 apiece for buying the 185 puts. They received about $3.40 apiece from selling the 165 puts. All in all, the entry cost is reduced to $4 apiece, bringing the total for the bet to about $1.8 million. Continuing with interesting trades, what about the bottom of the table? We have the ticker SPY. This is a put spread, but it is a calendar spread this time around. They bought the 358 puts for the expiration date September 30, and they sold the same one, the 358 puts, but for a different expiration date, which happens to be August 5th. They paid around $9.25 a piece for buying the 358 puts for the expiration date September 30, and they received about $3 and $15 a piece in credit for selling the 358 puts for the expiration date August 5th. All in all, the entry cost is reduced to about $6 a piece, which make the bet at about $1.5 million. And the bet here is simple. The SPY might catch a relief rally or whatever, but by September, it's going to trade below 358. Moving on to the heat map analysis, what's going on here? We're looking for consistency. Yesterday, energy was down, financials was down, materials were down, the defensives were down, and it was kind of a risk-on mode. We saw technology up, cyclicals up, software trading higher, chips trading higher. What are we seeing today? Well, the consistent themes are, number one, energy continues to be down. Number two, financials continue to be down. And number three, the big cap technology stocks are still trading in the green, at least today. So when everybody thought yesterday that it's over, yields are down, risk on, baby, dump the inflationary theme, go all in, buying the dip in RKK, yada, 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 that's not working so far. We're actually seeing buying the dip in what? The actual consistent themes for the year. The ultra defensives in utilities, in big pharma, in the defense contractors, and the consumer defensives, the consumer staples. And I've been saying for a while now, look at stocks that rely on government spending, not consumer spending. The big pharma names, they get paid by Medicare. That's not going to change. The defense contractors get paid by the Pentagon. That's not going to change. Utilities, can you get out of paying your utility bills? Of course not. And if you can't, the government is going to bail them out. Likewise, in consumer defensives, the staples, they still have the inflationary power, and they will maintain that advantage even under a recession. Therefore, they continue to outperform. But look at what happened to the cyclicals, for example. Yesterday, they were hot. Cruises, airlines, hotels, etc. Now, they're down big. So please don't get sucked in these fake rallies. These are short covering rallies, bear market rallies. You have to demand more consistency before you jump in. Show me the money. Show me the money. If you don't show me the money, I'm not interested at all. I'm going to stick to the winners, the consistent winners. Utilities, big pharma, defense contractors, and some of the consumer staples. That's it. What about the heat map for the ETFs? What's going on here? Muted across the board, but again, the consistent theme is the downtrend in energy, XLE, XOP, OIH down big. Commodities are down. While we have growth, slightly outperforming value, there's nothing to see here really in terms of a theme. We have to wait for the upcoming payrolls report because that will be a make or break moment for the stock market. When it comes to international, right across the board to muted, with exception of India, the ticker INDA, which managed to close in the green today, beating all international ETFs. Let's move on to charts, and we start with SPY, 30 minutes chart. What's going on here? We now have the ABC pattern completed, despite the hiccup that we got in the gap down after the bad news from overseas, from Europe. But the SPY, believe it or not, remains trading within a range. The support, 373.5. The resistance right now is 385. You look at the RSI, it is getting slightly overbought. It is really meaningless from a 30 minutes perspective. If it gets overbought in the daily, then we're talking. But this overbought condition, the RSI from the 30 minutes perspective, could produce a pullback, a mini pullback. The question becomes, will we see dip buyers showing up again? Will we see the SPY recovering once again? And most importantly, can they close the week above 385? That will be critically important for the bulls. The bears for now are waiting that this is within range kind of trading, and soon enough the SPY will move down to 373.5, retesting the support, and then it's going to fail. For now, who has the better argument? I would say the bulls, not the bears. Here's the daily chart perspective. What's going on here? Right away, you can see that trading remains within range. The resistance still at 3,855. The support remains at 3,720.5. The volume is kind of cooling down. The momentum indicators are still bullish. All of these are good signs for the bulls. What they're looking for is this pattern remains a higher low. And so long as that holds on, we have another higher low. And soon enough, the chart will make a higher high, passing above 3,960. Another scenario that the bulls are hoping for is the fact that this could be an ABC pattern, which will take us all the way to 4,100. But the bears would counter and say, wait a minute here. So far, this appears to be a bear flag formation. Another way we can look at it is this could be a reverse ABC pattern, which could take the chart all the way down to 3,600. Who has the better argument here, the bulls or the bears? The answer is the bulls, because they're supported by the volume and the momentum indicators, at least for now. What about the Qs? What's going on here? Closing at the highs of the day, no problems whatsoever. It is trading above 285. So far, so good. The chart's now eyeing the next resistance at around 297.5. But remember, we have soft resistance at around 293-ish. For now, the 30 minutes indicator on the RSI appears to be a little overbought. That can produce a pullback, perhaps a retest of 285. The bulls are hoping that if that happens, we will see a rebound and a blast higher again. A retest met with success. The bears are hoping that if we see a pullback indeed, that 285 is not going to hold, and that will be the end of this bounce, at least for now. What about the daily chart for the continuous contract for the Qs? The volume is cooling down, the momentum indicators are still in the green, still bullish, and the chart is trading above the support of 11,689. So far, so good for the bulls. And all the arguments that we applied on the SPY's continuous contract can be applied to the Q's continuous contract. But again, who has the better argument all in all? For now, the bulls do. What about the IWM? Perhaps this is where the bears can shine. This is a 30-minute chart for the IWM, which was an underperformer today. It was actually negative, and some believe that the IWM is a leading indicator to the rest, the SPY and the Qs. Well, if that is the case, then this appears to be a bear flag pattern. If it is, we could see a pullback all the way down to 168.90, which happens to be the support. The Dixie, what's going on in the dollar index daily chart? It continues to blast higher, supported by the momentum indicator, the RSI, and the MACD. We have plenty of room to go higher here, in the momentum indicators at least. The cup and handle is playing out, no problems here. But of course, a higher dollar is problematic for commodities. Not only that, but equities, the big caps shouldn't be rallying higher because they rely on overseas revenue. Gold, the daily chart, what's going on here? The flush down continues. Gold is becoming a little oversold from a daily chart perspective, but we have the Fibonacci support at around 1,685. If we have another shoot down all the way to that number, and it becomes really oversold, look at the dollar. Is the dollar becoming overbought? Is it showing any signs of a reversal, for example? If that is the case, then we could have a trade here in buying the dip in gold, maybe a rebound for a day or two, a week or two, we'll see. What about Brent oil? 4 hours chart, what's going on here? The flush down continues, but it is holding at the support of 100. It pierced below that for a little bit, but it managed to recapture it by the end of the day. Now, who knows what's going to happen overnight, but a crack below 100 once again will seal the deal that we're done. We have the top in oil. At least we have a 60% chance that we got the top in oil. Now, I'm waiting for the fundamentals to confirm that, and if that is the case, then we do have a recession underway. But if the dip buyers show up, betting that inflation is not over yet, and perhaps the drop in commodities will push the Fed to become more loose when it comes to tightening, then we could see a rebound. But that depends on the dip buyers. The psychology, however, doesn't support that. The psychology says all of those who were waiting on the sidelines while oil was rallying higher day after day, week after week, and they were missing out, they were saying, oh, wait for a pullback. When the pullback happens, we'll buy. Well, here's the pullback. Are they buying? Of course not. Because when you see this kind of declines, it kind of scares the bejesus out of you. And all of a sudden, all these folks who said, oh, we're waiting for the dip to buy, all of a sudden, they're nowhere to be found. And we see more sellers showing up, more stampeding and booking whatever profits by the holders. And that produces a cascading impact to the downside. What about the 10-year yield, the daily chart? What's going on here? It appears that we have a rebound, not quite for my number, 2.72, but a little above that. You look at the RSI, the momentum indicators, all curling higher. So is this it? Is this it in the dip in the 10-year yield? If it is, then we have more expectations of tightening and higher interest rates. This is not going to be good for the equities market. The TLT weekly chart, what's going on here? A pullback, reversing the gains for the week. But the week is still young, and it is really, really oversold from the momentum indicators perspective. I'm waiting for the confirmation in the MACD by producing big, beautiful green impressions on the histogram telling us that the negative momentum in the TLT is over, and we have a new bullish momentum. Who knows how long that will last, but we can trade that, right? The VIX 4 hours chart, what's going on here? Inconclusive. Look at the MACD indicator. It is not showing us clear direction one way or the other. You're not seeing big, bold, beautiful red or green impressions on the histogram, and therefore there is no conclusion here, even though the VIX bears / the SPY bulls have a slight advantage here. Why? Because the VIX is trading below the last support of 27.77. What about the VXN 4 hours chart? What's going on here? Again, inconclusive. Look at the MACD indicator. We're not seeing any clear direction one way or the other. For now, do the bulls have the advantage or the bears? I would say nobody really, because the chart's still trading above the support of 32.72. If that's broken, once again, then we're talking. What about Apple? What's going on here? It got exactly to the gap resistance and it decided to park right there. If the bullish momentum continues, then the next stop would be 145. And that will complete the ABC pattern. If not, if this resistance is going to hold, then we will see Apple moving down and losing 138.79. That's all there is in the rebound rally. So watch out for these numbers. Tesla, the souffle, 30 minutes chart. What's going on here? It is knocking over and over and over again at 700, but it appears that 700 is tough to crack above. It's going to be a decisive closing for the week. Can the bulls push harder to get TSLA above 700 by the end of the week? That will be a major win for the name and the bulls. But if they can't do that, then what's going to happen? The sellers will show up. They will smell weakness. The chart cannot crack above 700. They'll take profits. We will see the sellers piling in along with the bears, and that will produce a flush down scenario, which could produce a double top at around 700. BTC, Bitcoin, what's going on here? No update at all. It remains a bearish formation, but we're not going to make one move or the other because unless we have a loss of 20,000 of support for good, we cannot really short BTC. Likewise, we cannot buy until we see clear indications that we are back at risk on and the worst is behind us. And here are the bonus charts that I was talking about. AMD, a weekly chart. Few notes here. Number one, the head and shoulder formation. Number two, the rectangular pattern, or range, I should say, in yellow. It has been a consolidation range with defined support and defined resistance. For now, we got to the support, and the assumption is we should get a rebound higher. Number three, we have a gap at around 95. Could the rebound get us all the way to 95? That's what the bulls are betting for. On top of that, look at the MACD indicator. Last time around, we got a failed attempt in crossing to positive territory, indicating bullish momentum. Could it happen now? We're still a long way from that happening, but continue to watch the RSI, the MACD indicators. If they improve, then we have good signs that AMD could pop higher and close the gap at 95. Here's another chart for the ticker ODFL. This is for Old Dominion Trucking. When you have diesel prices down, when you have gasoline prices down, when you have wage inflation kind of cooling off in trucking, yes, if we have a recession, that would be a headwind, but we have tailwinds in the inflationary pressures easing. When you look at the chart, we have a descending sloping line of resistance. This is a weekly chart. You look at the MACD indicator. It is about to cross. It is about to reverse the bearish momentum and create new bullish momentum. It has already crossed above the sloping line of resistance. This is good news. Now, can it close the week above that? This is what I'm betting for, and therefore I bought call options in this name. I wouldn't buy the stock. I'd like to do that via call options to de-risk in case we have a crash in the stock market entirely, which will take this stock down too with it. There is no escape. If we have a crash, everything crashes. But again, this is a good looking chart because when you zoom in to a daily chart perspective, what do we see here? We see a double bottom formation and the chart moving above the resistance in the sloping line. So far, so good. And again, the bet here is that we will see a pop that will take us all the way to the next resistance at around 290 to 300. With that, folks, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have, per usual, the initial jobless claims. We also have, here he is, St. Louis Fed President James Bullard speaking. And then also from the Fed, we have Governor Waller speaking. We'll see what they say, but for now, the market is waiting for the most important jobs number on Friday. That will make or break the stock market. So buckle up your seatbelts. This is all I got for you for now. Thank you for listening. Thank you for watching. Now we'll talk to you again tomorrow.